Hello everyone! Welcome to the first episode in a full weekly educational series where I'm going to teach you everything you need to master technical analysis. From market structure to multi-time frame analysis, liquidity, order blocks, volume profile, VWAP, Fibonacci, and complete trading strategies, one concept at a time. And what better way to start than talking about technical analysis, also known as TA. If you ever opened TradingView, looked at a chart and thought, God, how do people actually see opportunity in this mess? Then this video is for you. Because today I'm going to show you how to read a chart like a trader, step by step. Not with 20 indicators, not with random guesses. But with technical analysis and one of the most important concepts in trading, confluence. By the end of this video, you'll understand how traders build real setups using tools like volume profile or VWAP. So if you're a beginner, this is the foundation you need. Let's get into it. So first, what is technical analysis? Technical analysis is simply the process of studying price action on a chart in order to make trading decisions. Instead of asking what's the news or what's the hype, technical analysis asks one thing: what is price actually doing right now? Because price reflects everything: buyers and sellers, fear and greed, liquidity, and levels where institutions are interested in. Technical analysis is basically the language of the market. Any traders use it for one reason only: to find high probability areas to enter and exit trades. Not prediction, just probability. Beginners often ask, is technical analysis really working? And the answer is yes. Technical analysis works because markets are driven by human behavior, and human behavior repeats. Traders react to key levels, breakouts, fear of missing out, and stop losses getting triggered. So, charts create patterns, not because they are magical, but because people are predictable. That's why support, resistance, volume zones, and VWAP matter. Now, here's where most beginners go wrong. They open TradingView, and they add all the indicators they can find. RSI, VWAP, Bollinger Bands, and 10 moving averages. And suddenly, the chart looks like a spaceship dashboard. This is not trading. Professional traders look for a few key tools that actually matter. Let me show you the ones I use. Number one is higher time frame environment. Before I draw anything, I always zoom out, because the first question is not where do I enter. The first question is what type of market are we in? Are we in a range consolidation or an expansion trading market? On the higher time frame, I want to see if price is respecting clear boundaries. So that means we are in a range and we can use our range tool to find that out, finding the pivots, and then we have the range. Or price is printing higher highs and higher lows, so we have an uptrend. And the third option, price is printing lower lows and lower highs, and we are in a downtrend. This step is crucial because the way you trade the market depends completely on the environment. Ranges rewards patience and mean reversion trades. Trends reward pullbacks and continuation setups. Only after I do this analysis, I move down to the lower time frames and start building a setup. Number two is volume profile. Volume profile is a tool that shows you where the market has traded the most volume at specific price levels. It helps identify important areas of value and liquidity, where price is more likely to react or consolidate before making its next move. Instead of guessing levels, volume tells you where the most transactions took place, where value was accepted, the price where many traders wanted to do business, and where price might react again. High volume zones act as support resistance. Low volume zones are areas where price moves fast. Number 3 is Fib retracement. Fibonacci is a tool that helps traders measure how far price might retrace after a strong move. It highlights key levels where buyers or sellers often step back in, making it useful for finding high probability pullback entries and targets. The market rarely moves in a straight line, so instead of panicking over a pullback in a strong trend, you can use Fib retracement to identify the zone from where you can jump in the trend again. Fib shows you common retracement areas like 3A2. In strong trends, this is the Fib you want to hold price. 0.5 is more useful in TradFi, crypto not so much. 618 to 65, it's also called the golden pocket and is the most important zone in the Fibonacci tool. 786 is often useful because due to many trigger stop losses in a zone, price might fall below golden pocket. And the last one, 886, the last chance for price to react from. Fib isn't magic, it's just a tool to measure structure and pullbacks. Number 4 is VWAP. VWAP stands for Volume Weighted Average Price. It represents the average price the market has traded at, weighted by volume. Traders use it as a dynamic fair value level to judge whether price is trading at a premium or a discount during the session. VWAP represents fair value. When price is above VWAP, we have a bullish bias. When price is below VWAP, we have a bearish bias. VWAP is amazing for entries, trend continuation plays, mean reversion setups, but I find it super useful as confluence along Fibs and volume profile. Now, here is the most important part, confluence. What confluence is? Confluence means stacking multiple confirmations in the same area. One signal alone is weak, but when multiple tools agree, that's where high probability trades happen. For example, if price hits a support level aligned with the VWAP inside the Fibonacci retracement zone at a high volume node, that's confluence. That's not guessing, that's a setup. The more reasons price should react, the better the trade. But here is the key thing you need to understand. Even if you have 5 different confluences lining perfectly in one zone, that does not mean price will automatically react. Markets don't owe you a bounce. That's why I personally don't just place random limit orders on levels and hope for the best. Instead, I use confluence to identify an area of interest, and then I wait for an entry confirmation, like a market structure break, a Fib retest after a confirmed market structure break, or momentum returning in my direction. Confluence gives you the zone. Confirmation gives you the trade. Alright, now let's do it live. Step 1. Start with a clean chart. No indicators, no clutter, just price. Step 2. Let's identify the market type. Since all-time high, we are clearly in the downtrend because price is making higher highs and lower lows. But every downtrend will find eventually its support. So we need to find our support zone for a potential bounce, and we also need to find our resistance zones that might continue to keep price in a downtrend. For that, we go to step number 3. We use Fibonacci for pullback zones. The Fibonacci tool, you'll find it on the left side of the TradingView panel, here under the second option. If you click on the right arrow, you'll find it at the top of the list. The second one, trend-based Fib extension, is also a very useful Fibonacci tool, but about this one we'll learn in a future video. For now, we'll use Fib retracement. Click on it. To identify our resistance zone, I will use the all-time high pivot. Let's zoom in a little, this one, and the last low we have. In order to identify our support zones, I will use the all-time low from bear market and the all-time high pivot, which is from here to here. Let's zoom in a little bit here to make sure that we have the right low. Let's see, it's this one here. And also, let's check the all-time high to be sure that it is in the right place, a little bit higher. This is it. Now, we can see that price already moved through the 382 level, so we'll remove this one. We don't need it anymore. Keep in mind that your fib will always move with price. That means that if we'll make another low in the coming days, this fib retracement that I used from all-time high to this low now will move to the next low. For the time being, I will leave it here where it is our last low. Come on, here. So make sure to check your tools at the start of every day. The next step, step 4, is we add a volume profile. Volume profile is found again on the left side of the panel under this little arrow here, and it's called fixed range volume profile. We'll click on this one, and I will add a volume profile from all-time high to where the price is now. You just click the starting point and let it go at the end. This way we have a value area low, a point of control, the red one, and a value area high. Let's add also a volume profile from bear market lows to all-time high and see what that gives us. Big cluster of volume here where price stopped. Point of control is down here on the 886 and value area low is all the way to 16. Now you can see without using any volume profile on the chart that in zones like this where price ranged or consolidated, we most likely have a bit of volume because this is where price spent some time, so many contracts have been exchanged, so a lot of volume. When we add volume profile, we want to know where did the most transactions took place, where both sellers and buyers wanted to do business. High volume nodes become magnets for price. As we can see, this cluster of volume here hold price for the time being. And we also can see that below golden pocket and below this wick here, there's not much volume to hold the price. So as we've learned in the previous slides, if price goes below this wick and doesn't just react with a simple swing failure pattern, chances are she will move really fast to the next support zone, which is 786. Step number 5, we add a VWAP. I will use an anchored VWAP, which is found under the same arrow with volume profile, and it's called anchored VWAP. I'll click on this one and I will add it from the all-time high. Here you can check source. Where do you want your VWAP to start? At the high of the candle, low of the candle, or close? I will use the high. When we have the VWAP on the chart, we check whether price is above or below VWAP. That tells me whether buyers or sellers have control. And as we can see on our chart, price is clearly rejecting from VWAP and it's still below it. So we are still in a downtrend. We can also add, if you want, an anchor VWAP from all-time low bear markets or from other important pivots. We'll get more into VWAP in a future video. After adding all our tools on the chart, we look for confluence, which is step 6. The question is, do multiple tools line up in the same area? Let's have a look. Zooming in a little bit because this is a bit of price action that we are interested now, we can see that our first resistance zone, it's all the way up to 85k, which is a long way, it's a long distance until there. Because of that, I will use another fib retracement for the last main high, which is this one here from January, to the current low. Let's add the 382 here. Okay. And now we can see that we found some resistance zones. We have the first one here at the 382, but this one is a bit tricky. Why? Because as we can see, we don't have much volume here. The next important area will be golden pocket, 382 and value area low up here, because here is where we have the most confluence on our chart. Also above we have a point of control with a big volume area here on the 786 This one will be the next one. And as we said, 886 now aligns with VWAP as the last line of resistance locally. For support, the first one will be golden pocket, because this one is a macro golden pocket from bear market lows to all-time high. Let's see if we have any other things here. We have a bit of volume right on the top of the golden pocket. This is how you find areas of confluences. Places where multiple tools line up in the same area. That's where trades are built, not from one indicator, but from stacked probability. Before we finish, let me save you years of pain and tell you about the most common mistakes beginners make. Let's hide all the tools that we used and let's see common beginner mistakes. Mistake number 1, indicator overload. More indicators doesn't mean more accuracy, it means more confusion. Test every type of indicator you want, but pick a handful that you best understand. Backtest those you pick and see how price reacts to them, if they are lagging or they update with price, like volume profile and VWAP. Mistake number 2, trading without a plan. A huge mistake is thinking technical analysis is just about drawing lines on a chart. But TA is not about drawing, it's about having rules. Because if you don't have a plan, then every trade becomes emotional. One day you enter because it looks bullish. The next day you hesitate. Then you chase. Then you panic sell. Professional traders don't trade based on vibes. They trade based on repeatable process. For example, you should always know: what is my market bias? Are we in a range or a trend? What level am I interested in and why? What confluences support this zone? What confirmation do I need before entering? Where is my stop loss invalidation? Where am I wrong? Where is my target and what is my risk reward? That's what separates charting from trading. Anyone can draw levels, but consistency comes from having rules you follow every single time. Mistake number 3. Ignoring higher time frames. Another massive mistake beginners make is focusing too much on the lower time frame. They'll zoom in into the 5-minute chart, spot what looks like a perfect setup, and take a trade, without realizing they are trading directly into a major higher time frame level. Because here is the truth: higher time frames control the market. The daily and 4-hour charts are where the biggest money is making decisions. And that's what price respects the most. That's why professional traders always start from the top. Daily for overall bias, 4-hour for structure, 1 hour for key zones, lower time frame only for entries and confirmation. Mistake number 4. Looking for perfect setups. You want everything to line up flawlessly. You want zero drawdown. You want a trade that feels guaranteed. But the reality is, trading is probability, not perfection. Even the best traders in the world lose trades. The goal is not to be right every time. The goal is to consistently put yourself in situations where the odds are in your favor. That's what confluence does. It increases the probability of a reaction, but it never guarantees one. Sometimes price will hit a perfect level, with VWAP, Fib, volume, structure, everything aligned, and it will still break through. That's just how market works. So instead of chasing perfection, focus on consistency. Take high quality setups, manage your risk, accept losses as part of the game, and let probability play out over many trades. Because probability doesn't come from one perfect trade. It comes from executing a solid edge repeatedly over time. So, to recap, technical analysis is simply reading market behavior through price. And the best traders don't rely on one tool, they rely on confluence. Identifying market type, volume profile, Fibonacci, VWAP. These are my personal favorites, but maybe during the coming weeks, when we'll go through more tools, you'll find others that work for you. Stack confirmations, trade with probability. Now, in the next video, we are going into one of the most important foundations after this one, market structure, higher highs, lower lows, and break-up structure. That's where trading really starts making sense. So if you enjoyed this one, drop a like, subscribe, and I'll see you next week. Bye bye.